Welcome back to the forum. Please be reminded that we have Spanish and French translation available, but we will hold the panel in English. Again, like in the first session, if you have questions, please use our question function, and Diara, our co-moderator, will again be happy to feed them into our session here. My name is Thomas and I'm your moderator. In our previous session, we have looked at the topic of today from a very general perspective. What is it and what could be the importance of contracts for climate change and just transition? We heard from Chucks from Nigeria that poorly negotiated contracts really create lots of damages, and not only to the country's budget, but to the people and also to our endeavor to have a just transition. We heard from the German government that it is in the own interest of the global north to have better contracts if it comes to raw materials and critical minerals and to get this transition into a green economy. And now we want to do a more deep dive into this, going into critical minerals. And we talked about this already this morning. And I'm really delighted to welcome two well-known experts to this session. First of all, Nicola Woodroffe is with us. She is a senior legal analyst at the Natural Resource Governance Institute with several years of experiences and in advising governments and non-governmental stakeholders in research-rich countries and extractive sector policy. She has provided globally technical assistance, capacity development, and analysis on legislative policy and institutional reforms, as well as contracts allocation and monitoring. Nicole, we are really glad you have joined us. Welcome to the forum. I'm really looking forward to your points. And then I'm equally honored that Lou Wells is with us. I think most of you will know him. He is a Herbert F. Johnson professor at the International Management at Harvard Business School. I hesitate to say Emeritus because I can actually not imagine that you are Emeritus, but that's maybe just a status, but it's not actually your activity. He taught courses and conducted research on international businesses, largely on investor-host government relations, and for close to 5 decades. It seems like you've always been there. And he advised governments and international organizations on foreign investment policy and negotiations, and he wrote this Negotiating Third World Mineral Agreements Promises as a prologue. Lou, we are really happy that we have you here, and I'm also looking forward to hear your points and your thoughts and the reflection of the both of you. Nicola, we will start off with you. Let's take the perspective of resource-rich countries. From your experience, what is it what they should bear in mind? What are actually their needs? And then we can maybe come to the other perspectives. But what should resource-rich countries bear in mind? Nicola, the floor is yours.
Thank you very much. Pleasure to be here. So, I mean, let's just pull back a little bit and make sure we're all on the same page when we talk about critical minerals. It can be defined in different ways. For the purposes of this discussion, we're talking about the minerals that are essential to our transition from fossil fuels to renewable energy, and that will be used in electric vehicles, in wind turbines, in storage batteries, in magnets, etc. So lithium, nickel, manganese, cobalt, rare earths, etc. And we expect to see a boom in demand and production of these minerals to facilitate our transition to a net zero economy by 2050, 2060, if we stay on track. So, you know, by some counts, for example, the International Energy Agency, we should see a 7-fold increase in the market. And so what this means is a huge boon to countries that are rich in these minerals. We're talking DRC that has approximately 50% of the world's reserves of cobalt, countries like Indonesia that are big nickel producers, they're going to see a huge boon because of this commodities dramatic increase in demand. But it's important to bear in mind that this is not going to be an indefinite boom. We're talking about a boom that will probably last around 30 years, give or take, perhaps, if we are on track as we expect to be to reach net zero. And why is this? Well, cobalt itself demand is quite precarious. We're already seeing innovations to use less and less cobalt in nickel, manganese, cobalt batteries. There are innovations to move away from cobalt altogether with lithium iron phosphate batteries. So cobalt demand is quite precarious. There are movements to substitute cobalt, use of cobalt in batteries. And in general, these minerals are for use in developing renewable energy infrastructure, but they're not fuels like fossil fuels. So you don't need a continuous and expanding supply to feed the renewable energy infrastructure. To some extent, once the stock infrastructure is built, demand will taper off to some extent. So this means that host countries, these countries that are rich in these minerals, have a particular period of time to benefit from this boom and to ensure that they get it right, to ensure that they use the revenues wisely, to ensure that they negotiate good deals, etc. And it's important to note that these minerals are found in significant parts in countries that are in the lower half of Transparency International's Corruption Perception Index and other indicators of governance and corruption issues. So this means that corruption, mismanagement, good governance issues have to be part and parcel in ensuring that these countries actually benefit from this boom in critical minerals. So there are a number of areas that development partners and host governments will want to focus on and work together on to ensure benefits to the countries and also a stable supply of these minerals to facilitate the transition globally. And, the first one that I would point out would be negotiating strong and durable contracts. There's much that we can say and that we will probably talk about later in the different types of terms that countries and development partners might want to focus on. I'll just touch on reconsidering risk allocation terms like force majeure, terms like stabilization clauses. Force majeure provisions are provisions that excuse a party from their performance of obligations under the contract in the event of unforeseeable circumstances beyond the party's control that prevents or hinder performance. And these terms generally include extreme weather events, storm, lightning, flood as a basis for force majeure. And considering that these events are becoming more and more frequent, it's very important that contracts don't just routinely include them, but include provisions that require companies to conduct climate impact risk assessments to build climate resilience into their project design, construction, and operations, that require them to obtain relevant insurance to cover climate events, to use renewable energy as far as possible, and that define specifically what unforeseeable would mean with respect to extreme weather events for the purposes of the contract, for example, by reference to climate data that's specific to that location or that region. Stabilization clauses, these are clauses that protect companies from changes in law that occur after the contract is signed. These are considered to encourage investments because they provide some kind of a stable and predictable condition for companies, but they also limit the flexibility of governments to update their regulatory framework over time, which is going to be very important, especially as countries implement regulations to address climate change, to implement their own climate commitments. So governments should really think about whether they want to grant a stabilization clause at all. But if they do grant a stabilization clause, they should be very narrowly drafted, limited in duration, focused on specific fiscal terms, with clear carve-outs for regulations that address environment, health and safety, labor, and definitely climate, including any climate regulations that might have fiscal implications, such as carbon taxes. Negotiating the right fiscal regime is also going to be critical to ensure that governments get a fair share of the revenues from these projects, while at the same time remaining competitive, and while at the same time designing a regime that is implementable based on their capacity. Governments will want to have a fiscal regime that allows them to easily, based on their capacity, calculate what companies actually owe, collect what they actually owe, address things like tax avoidance through strategies like transfer pricing. So, for example, using sliding scale royalties that are based on some kind of measure of profitability might be easier for some countries to implement than a complicated excess profits tax regime, but it really depends on the country. But beyond the contract, the context of contracting is very important. Having transparent licensing procedures will ensure a context in which corruption and mismanagement can be both deterred and detected if it occurs. And this would include practices that are part of the Extractive Industry Transparency Initiative principles and requirements, such as disclosure of beneficial owners of those applying for licenses, screening that beneficial ownership information for conflicts of interest, publishing contracts after the contracts are signed. The Natural Resource Governance Institute has a corruption diagnostic tool that will allow stakeholders to identify key areas or risks for corruption within the sector and develop an action plan to address them. So it's very important that development partners support these initiatives. Value addition is going to be key to host countries really maximizing the benefits from critical minerals, but to develop a downstream industry, things like energy shortage, transport infrastructure deficits will need to be addressed. So support will be needed in negotiating energy investments, negotiating transport infrastructure deals. And finally, I really want to flag the importance of addressing environmental impacts. This boom in production is going to open new tracts of land to mining, potentially threaten forest cover. So it's very important that governments and development partners work together to address environmental impacts, to address support in carrying out strategic impact assessments, in reviewing environmental and social impact assessments as necessary, in implementing climate smart mining practices, etc. So I'll wrap up there for now.
Yeah, thank you very much, Nicola. For what I took from it is that there is actually a boom, and that boom actually can create chances, not only for these countries in which those minerals are, but also for the whole world if we want to have this transition. But for this, it needs to be managed well, because if we do it like we did it in the last centuries, then we might just perpetuate the risk and the damages we've done before. And you also outlined all the necessities and requirements that might be needed. Still, the question is how stupid we humans are. We know everything, how we can do it better, and then we simply do it. We don't do it. And Lou, if we go into the necessity and speciality now of these negotiation contracts, I really hesitate to ask you a question because I'm simply here to listen to you. So if we can share, if you could share your experiences with us, also reacting maybe on what Nicola with her energy to change things brought into this forum here. Thank you very much, Lou, for joining us.
Okay, Nicola is a hard act to follow because she does this. Let me add a couple of things to Nicola's description of the environment with critical minerals. First, the critical minerals are attracting companies that are new to mining. A number of the critical minerals are mined at really small scale, and the big traditional mining companies don't seem to show a huge amount of interest in them. So we're now getting users of the critical minerals integrating back into mining. And we're also getting private equity firms interested in investing in some of the critical minerals. That changes the companies with whom the mining countries are negotiating. I think it gives them new opportunities because these new firms are not tied to old contracts elsewhere where they're afraid to negotiate something new because it might affect their existing agreements. Secondly, the vertical integration, that is users going back into mining, poses some problems that I'll mention in detail in a few minutes. And thirdly, Nicola has already suggested that these industries that use the critical minerals are the subject of constantly changing technology. For example, users of lithium for batteries have recently been substituting other minerals for lithium as the price of lithium rose to what they consider astronomical levels. So demand is constantly shifting across these various minerals. That needs to be kept in mind. There are three elements or issues in negotiating contracts for critical minerals that I think are especially important. The first is the importance of working provisions, that is, provisions in agreements and contracts that require the firm to use it or lose it. In other words, mine it or lose the contract. I'll talk about each of these in a little more detail. Secondly is the increase in diplomatic pressures in negotiating these agreements. Home governments of investors really care. That's why they list them as critical. Governments that have a lot of automobile producers or have any automobile producers are very concerned about their automobile producers' access, for example, to minerals that go into batteries. Countries are interested in the minerals for renewable energy, and that's governments are interested. Same with electronics involved, especially in defense. And thirdly, there's a special need to deal with prices of these minerals in contracts for setting royalties and taxes, because many of the minerals are not traded on open markets, such as the London Metal Exchange. I want to say a little bit about each of these three subjects that are especially important. First, you have to have working provisions. In other words, you have to have provisions in the agreements that say you mine it by a certain date and you continue to mine, or you lose the contract and we as a government will go look for someone else. Investors are going to be contracting for more than they need, or at least that's very likely, because they don't know what they need. They just want to tie up resources in case they need it. Evolving technologies mean that what they contract for now may not be needed in the future. So the result is they may never start mining, or they stop mining much earlier than expected. So you need provisions that say you don't use it, you lose it. The second issue that I mentioned is diplomatic pressure. That has to be managed. Your Foreign Office, or whatever you call the equivalent to the U.S. State Department, needs to be involved from the outset. You will face pressure from the investors' home country to give their investors the contracts. I've seen this in other minerals. I've seen threats that will be honest, from the U.S. president, saying if you can't give this contract to a U.S. company, we'll reconsider our aid to you. You've got to turn this around so that it's not a threat from the home country. It's a threat from you that if you don't give us something, we're not going to deal with your mining company. Thirdly, the pricing provisions are going to be very important. As I said, most of these minerals lack an open market. You can't simply base your royalties or your corporate income tax on prices of the mineral on the London Metal Exchange. The transactions from the mine to the processor and from the processor to the end user may well be internal to the corporation. Vertically integrated companies sell to themselves. They can choose whatever price they want, independent of open markets. Or the sales are likely to be under long-term contracts, the terms of which may not be visible to you, and they may not be what you want to use for determining royalties that are owed or for determining profits for corporate income taxes. You need help in this. You need help in setting advanced pricing agreements in your original contracts so you don't end up with disputes that lead to international arbitration and the kinds of awards that were described in the previous session. I'll leave it at this right now and respond to questions.
Yeah, thank you very much. A lot of points. I'm just thinking in which direction we go, but I think it is best that we ask maybe our audience, because we do have questions from our audience, and I think that's best that you guys can communicate with each other. So, Diara, could you bring in some of the questions from the audience, please?
Yes, sure. Thank you, Thomas. We have a first question coming in from the audience that refers to the management of additional revenue because of high commodity prices. As we've heard, the current boom in commodity prices could bring significant economic opportunities for developing countries. So the person is asking if there are any mechanisms that governments can adopt to ensure that these revenues are wisely spent.
Nicola, you want to react to this?
Sure. Age-old problem, right? As you said at the very beginning, these are the problems that countries have struggled with for decades. These aren't new.
Yeah.
A number of practices, transparent budgeting practices, investing in spending the money on not current expenditure, but investing in infrastructure, investing in the kinds of expenditures that would facilitate development of the economy. So, not you spending on white elephant projects, having strong government procurement practices and transparent practices so that there's transparency around how contracts for different projects are selected and are carried out and kept within budgets. In some cases, having some kind of sovereign wealth fund might be appropriate, or it might not, because usually some of these countries have more pressing development needs in the now, but considering how to save or how to have a stabilization fund to manage the volatility of prices might be a good idea. So there's several strategies: transparent budgeting, transparent government procurement practices, spending wisely, not using it for recurrent expenditure, because these revenues are volatile. So you actually want to invest them in infrastructure, in other development facilitating types of expenditures, and considering whether some kind of a stabilization fund might be appropriate depending on the revenues that we're talking about. These are all different kinds of strategies that might be considered. And again, these are not new. These are strategies that have been discussed for decades with respect to how resource-rich countries should manage their resources. So I think it's very important to say that we're not reinventing the wheel here. I think this is another opportunity for countries to go back to some of the foundational good governance practices and really get it right this time. And, for stakeholders of all kinds, including development partners, to work together to hold countries and governments to account to do this. And, for governments that actually are very motivated to actually adopt these practices and go back to first principles to some extent.
Yeah, thank you, Nicola. It looks like Lou also wants to add something to this, or am I interpreting this wrong?
You're interpreting it wrong, but that doesn't keep me from speaking.
Okay. But I would then have a question
my
to Lou.
expertise is in my expertise is in helping governments get the money, not in helping them spend the money. On the other hand, I think you need constantly to remind yourself that the income from mining is coming from the wealth that you have in the ground. This is capital assets that you are depleting when you mine them. And you need to take those resources as much as possible and turn them into other capital resources, that is infrastructure, other investments. So you have to remind yourself, don't spend it on current needs, spend it on capital investment to the extent possible. And I think Nicola was saying the same thing.
Yeah, thank you. But Lou, I would have a question to you. I was a little bit astonished to hear that you have this, confident into diplomatic pressure and foreign offices. Could you elaborate a little? I understood the concept, but in reality, how does it really look that the foreign offices actually come into the place and support these kind of development you're asking for?
Well, I'm not sure they support it. They're trying to get the deals for their own investors. It's very clear the U.S. has been active in the Democratic Republic of the Congo, trying to get U.S. firms to have investments in cobalt, as they are disturbed by the cobalt being possibly under the control of the Chinese. A German government is very interested in supplies of lithium for their own automobile producers, and they would like at least some reasonable amount of lithium in the control of German mining companies. This shouldn't be a surprise. The question is how to manage it as a mining country. And I think that people from the Foreign Office should be directly involved in the preparation of negotiations with foreign investors in order to turn the interest of the the involvement of the home country government into developing, supporting the interest of the mining country. That is, don't threaten us with taking away our aid, provide us more.
Yeah, right, yeah. And maybe that also would put some pressure on the diplomatic people, saying, okay, we need different skills and also competencies in order to do what you just outlined. But I'm sure we have more questions from our audience. Diara, please.
We have another question indeed. That one is for Lou. So it goes more in the direction of how governments can deal with prices of critical minerals in contracts. And the person from the audience is pointing out the fact that in the context of crisis, we have seen a surge in fossil fuels. And so there might be a chance for weaker demand in critical minerals. And the person is asking what aspects or clauses of contracts can help protect governments against the price fluctuations. I think Lou spoke a bit about it when speaking about pricing provisions. Maybe you could explore a bit more on that.
Sure. If I were an advisor to a mining country negotiating a contract for a mineral that doesn't have open markets, that is not traded on the London Metal Exchange, for example, I would make sure that I had with me an expert who's had considerable experience in negotiating advanced pricing agreements. And let me just take an example. Connex provided an expert to Liberia on advanced pricing agreements. It was someone who had worked actually in the US Treasury in the past and was involved in negotiating on the other side for the US government advanced pricing agreements. That expertise, that expert, led the Liberians to negotiate an advanced pricing agreement for a mineral that seems to have stood up well and seems to be working. I would get an expert in that particular subject involved.
Mm-hmm. Okay. Again, that's the point we yesterday had, that just enable the governments and the people who negotiate to make informed decisions. And for that, they need experts on the table that actually, which I usually call, they are not doing this terror of experts. They're simply consulting the people and empower them that they can make a better decision, and not actually driving the decision as so-called experts, because it looks different from all different perspectives, and we have so many perspectives here. Do we have a last question from the audience, Diara, for this session?
Yes, I have a bit of a more general question for Lou. I find a very interesting one. So one person is asking, what was the most disadvantaged deal that you have seen in your career and why? And what would you have advised the government, of course, keeping the country anonymous? Would you like to answer that one?
What was the most advantageous deal? Is that the question?
Disadvantaged deal.
Oh,
Disadvantaged.
disadvantaged.
Disadvantaged. Yeah. Don't talk
I'll have
about
to
the
think
car
about
you
that
just
for a
bought.
while.
Yes. Yeah.
I'm not sure I can answer that. I mean, as an advisor, you're always in the position. I'm not advising anymore, so I can say this. You're always in the position of the government's not following your advice, and usually there are good reasons for it. You know, you're an outsider. You don't understand all of the internal issues involved, especially the political issues. One of the things that have not encouraged, and I think has led to some very problematic decisions, I'm not sure it's led to the worst agreement I've ever seen, but that is the government insistence on taking equity in the investment. Equity in government hands can be very dangerous because the government can expect much more out of it than it actually receives. Government officials often think of dividends from equity as being the equivalent of taxation. In other words, if they own 50% of the equity, they get 50% of the dividends. and think that's like a 50% income tax, and it's far from such. And the equity requires additional provisions in the agreement to cover the position of the government as a minority equity holder. It can be done, but a simple insertion in an agreement that the government gets some percentage of the equity is usually very disappointing, leads to very disappointing outcomes for the government. So if the government insists on equity, it has to insist on a lot of other provisions to protect what it receives from equity. And perhaps some of the worst agreements I've seen are agreements that call for government equity and do not provide for adequate protection for the government in the results of holding that equity.
Mm-hmm. Yeah, thank you very much. Nicola, you want to react to this, or we leave it with this?
On the on the state equity point, this is something that's actually coming back. There is a lot of interest in governments acquiring state equity, and so I think what Lou flagged is actually a really important point to underscore, that not because you have state equity, 10% means you're going to get 10% of the profits. There are many strategies that companies can use, legitimate strategies, reinvesting in expansion, in upgrades, or transfer pricing and other sort of tax avoidance strategies to minimize the dividend payout. So governments might find that they're quite disappointed in how state equity performs. So as Lou said, it's very important to design these terms and the conditions around them carefully. The World Bank and the African Mining Legislation Atlas and the African Legal Support Facility just recently published a toolkit on state equity that has a lot of interesting and good information on the various considerations that governments should bear in mind when they are determining whether they should have state equity, how much, and how to design the terms and conditions around them, who will actually be the one holding the state equity on the government's behalf, etc. So I would flag that also to our listeners, that it's a useful resource. And just, in designing the fiscal terms in general, a point that I made earlier and that I'd like to return to is that it's important to get assistance in fiscal modeling to actually see how the tools perform together, but then to also consider implementation, because certain tools, state equity, income tax, excess profits tax, are more susceptible to tax avoidance practices than other tools, such as royalties or sliding scale royalties, depending on what the mechanism that the sliding scale is based on, whether it's price, whether it's some measure of profitability, etc. So I think it's important for development partners and governments to also consider those factors when support is being provided, not just on how the provisions perform on paper, but what will be the requirements on the government to be able to audit, to be able to implement them, and is the capacity there? Is additional capacity needed, or is there an advantage in going with a simpler combination of tools that still have the required flexibility? Because there was that question on changes in prices, and not all the critical minerals will be those that don't have public pricing. So for example, copper could be considered a critical mineral. There's already a large market for copper, but more will be needed. So copper-rich countries will also see not as much of a dramatic percentage change, but they will still see a lot of revenues from copper. Having progressivity or flexibility built into your fiscal regime, having tools that are responsive to changes in price or changes, more importantly, to profitability, will ensure that that the regime is responsive to changes in circumstances as a built-in component of that fiscal regime.
Yeah, thank you very much, Nicola. I'm afraid slowly have to come to an end of the session, but I have one last question, which actually is in my mind. You're both Harvard University, and not far from your offices is, or where you actually studied or taught, there's this Harvard's negotiation model. And did you as professionals ever get in contact with a colleague of the Harvard negotiation project at the Harvard School of Government? Because these guys developed this concept of how to make negotiating transparent and on equal footing. Did you ever work together with your colleagues at the university from there?
Of course. In fact,
Good. Yeah.
in fact,
Yeah.
one of the mining agreements that I was involved in was written up years ago as a teaching case and taught by some of the faculty in the negotiation group, which crossed the law school and the Kennedy School of Government and the business school.
Yeah. Yeah. Super.
We speak to each.
Yeah, I'm glad to hear this. Yeah, I'm glad to hear this. That you, Nicola, also, or you?
Well, less so. I mean, the aspect that I work on is less directly in the negotiations. I don't, as NRGI, we don't get involved in the actual negotiations of contracts. We support in governments developing the conditions around negotiations, the correct regulatory framework, legislative framework, etc., and advise on the types of terms in contracts that governments should be aware of and what their implications are of different choices in drafting. When it comes to actually being in the negotiation room, we don't do that. So I haven't done that for many years. My actual transactional work has, been from several years ago on different issues. And I more focus on the conditions around and the preconditions to actually going into the negotiation room. So Lou and I are addressing it from two different sides, and together we hope that we support host governments in making the best deals.
I take this as a closing word, but Lou felt like he wants to say something.
You always think I want to say something. No, I'm finished. Thank you.
That's maybe because you look so curious. Yeah. Okay. Thank you very much for this forum. I found it very enlightening, and we will have a short break right now, and then we'll resume here in 12 minutes. In our next session, we again will change our perspective, this time towards the partner countries and the special challenges that needs to be addressed there. Join us in 12 minutes here, and then for our session, assessing the needs of the partner countries and closing the capacity gap. Nicola and Lou, thank you very much for this session, and also thanking our audience for the question that gave us a really interesting discussion. Thank you very much, and see you soon. Maybe you stay tuned. See you. Bye.
Thank you.